Well, good evening, everybody. Welcome back to my empty house that has been stripped of all my valuables because of my destructive separation. Welcome back to Strongman Personal Finance. We got a sponsored video today. And if you want a sponsored video where you send me money and I make a video about whatever you want, I don't do stock price predictions, okay? I don't do valuations. But I am a certified public accountant. I can explain financial statements to you, okay? See the pinned comment below at the conclusion of this live stream if you want to give me your hard-earned money to make a video. So anyway, in this video, we're going to cover Spirit Airlines. Ticker symbol SAVE, S-A-V-E. Why? Because you're saving money, bro. Because instead of taking a normal airline, you take Spirit, you pay 20,000 different freaking fees, but you get somewhere cheap. And, I got a story about a budget airlines. But anyway, let's go ahead and check out Spirit. Okay, we're sharing here. So here's Spirit Airlines. The first thing I want to cue you in is a market cap of $270 million and a stock price of $2.47. Okay, if I was a bigger YouTuber, I wouldn't even talk about this. This is a penny stock. That should tell you one thing. Let's look at the stock price performance. Now, I believe overall in efficient markets. I believe, when stocks go down, it's for a reason. And when stocks go up, it's for a reason. It's the market, looking the collective wisdom of the market, determining the price of the stock. This thing is down 93% over the last 5 years. Okay. It dropped massively during the clown-demic. It rallied probably because people are like, oh, we got to buy airlines, bro, because we're going to open up soon. Everybody's going to be flying again. And yeah. And then ever since late mid-2021, the stock has been on a steady downtrend. And it's now a freaking penny stock. Okay. That's not good. They do have revenue, at least, of $5.13 billion over the last 12 months. Net income of negative 676. Okay. They're losing money. That's not good. And earnings per share of negative 6.2. So the share price is $2.47 over the last 12 months. For one share, you lost $6.20. Okay, that's like equity annihilation. They have a dividend. I don't believe that. It's probably some one-off thing. If they have a dividend at this point, they're freaking clowns. Okay. Yeah, ex-dividend date February 22nd. They probably suspended the dividend. And analysts say sell, and, I don't do recommendations, but I would not put a lot of money in this thing, okay? This is a speculative investment. I'll just leave that there. Spirit Airlines provides airline services, really. The company also offers hotels and rental car services, okay? It serves 93 destinations in 15 countries in the U.S., Latin America, and the Caribbean. As of December 31st, the company operated a fleet of 205 Airbus single-aisle aircraft, okay? Well, at least they don't have Boeings, because we've been hearing some very scary things about Boeings. Now, this is a low-cost airline. Now, I had an experience with a company called Breeze when I went to go down to Florida to make sweet love to Jay Nagy. I took Breeze Airlines out of Norfolk. I flew from Norfolk into Tampa. And the flight there was fine. You got to pay you basically have to pay for everything extra. Oh, you want to sit here? You got to pay. Oh, you want to do this? You got to pay. Oh, you want to take a dump? You got to pay. Basically, the way these airlines make money is they have like really low fares. They get you on the plane and they try to nickel and dime you for everything. That's how these companies make money. These appeal to like cheap people. Okay. Very cheapies. And if you think about it, cheapies are or people that don't have a lot of money are getting really hurt in this economy. Some people are doing great, but if you're like really low income, inflation really hurts you, okay? That's the type of person that would probably use Spirit Airlines. So that right there is probably freaking concerning and probably one of the reasons the stock is selling off, okay? But that's what they nickel and dime you. It's a cheapy company. Anyway, let's go ahead and check out the overall financials, and then we're going to look at the most recent quarterly report. So their operating revenue has flatlined, okay? This is, they make money from tickets. They make money from selling amenities and this fee and that fee and whatever freaking fee, okay? Operating revenue's flat or actually down a little bit year over year. Other revenue, we'll see what that is. It's a very small part of their revenue, $27 million in the last quarter versus $1.2 billion. But their other revenue has been going up, but it's very immaterial. Their total revenue is down 10% year over year. They still have a gross profit, okay? This is their profit, before all the other admin expenses. Gross profit is like your revenue minus the direct costs of the product or service that you sell. So they at least have a gross profit, but it's massively declined. You can see the trend, massive decline. This company's getting squeezed. Why? Well, could be inflation. It could be massive competition. Okay. This is the airline. How many freaking airliners are there? This thing's probably going to get scooped up by another company. Oh, wait, that got shot down by the Department of Justice. I think multiple companies have tried to acquire Spirit Airlines, but the government wouldn't let them. Google's fine. You know, hyper monopoly. Amazon's fine. Microsoft's. But Spirit Airlines cannot be acquired by JetBlue because, we're saving the country from monopolies. So margins we see are massively contracting. Operating margin is negative. They are losing money even before interest and taxes, okay? Negative 13%. This company has turned a profit from operations. I can see 1, 2, 3 quarters in the last 5 years. Okay. This is not, you're in a highly competitive industry and your claim to fame is what? You sell crap tickets. You sell like nickel and dime tickets. Like, I don't know, man. And free cash flow is negative. So basically, you know, you make money from your operations. You take the money, you buy airplanes or whatever. And whatever's left over is money you can use to pay dividends, pay off debt, blah, 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 buy back shares. They have negative so their core cash flow from their core business is negative. Okay. They can't make any cash. They just burn money left over right. What happens when a company burns cash? They have to get it from somewhere. They have to borrow it, or they have to issue shares, or they have to sell equipment, property, plant equipment, which is what they seem to be doing. So it looks like they're probably selling off, I don't know, planes probably. They're selling off a bunch of assets. That's not a good sign. Okay. This company's downsizing and they're selling off their assets just to stay alive. That's what they're doing. I mean, they invested all this money in these planes or whatever, and then they freaking sell them off. And they rent planes too. But I mean, this is a massively contracting business. So let's go ahead and look at the 10Q. Okay. Are we sharing? Okay. We're sharing. So Spirit Airlines Incorporated, this is the financial reports as of June 30th, 2024. So keep in mind, this is as of a couple months ago. So we'll look at the balance sheet, or we'll start with the consolidated statement of operations, or the profit and loss statement. So we can see passenger revenue is down. We know that. We knew that. We saw that earlier. And we know other revenue is going up. So the very smallest part of their revenue, like a very immaterial portion of their revenue, is the only thing that's growing. But passenger revenue took a big shellacking, okay? So either there's not as many flights, or just fares in general are coming down, which looks like here, you can see year over year, like ever since June 2022, fares have come down. And they're dropping actually below the historical norms before the clown-demic. Look at that. So before the clown-demic, you know, this is like the CPI index for airfares in the U.S. was, you know, the index was at 259, 260. Now we're at 245. Okay, so this is probably an indicator of either people aren't flying as much or massive competition. You can see fares are clearly dropping. And that hurts airlines like this that probably don't make a lot of profit. Okay, so their revenue declined for passengers. Their fuel expense went up, but nothing crazy. They could probably hedge that. Salaries and wages are up, but nothing crazy. Landing fees are up. This is like fees that airports charge. I thought airports were free, bro. Like, I guess every time they land, the airport charges them landing fees, is up 9%. So total landing fees, how much do landing fees eat up as total revenue? Landing fees eat up 9% of their revenue. That's interesting. Okay. Aircraft rent is approximately 10% of their revenue. That's up pretty significantly. Okay. So it looks like what I think is probably happening here, we saw that they're selling long-term assets. So I suspect they're just selling off airplanes they own because they're so freaking expensive. And instead they're renting the aircraft. Because you can see aircraft rent expense went up by 36%. 36%. That's a pretty big increase in aircraft rent expense. So either other airliners that rent the planes to them are jacking up rents, or whoever lends them airplanes, or they're getting rid of owning airplanes and trying to rent as much as possible. We can see depreciation is up. I mean, that's aircraft or whatever. Maintenance repair. Oh, they cut maintenance and repairs by $4 million. Distribution is down. Special charges and credits. So I don't know what this is. Like maybe we'll see somewhere else. Loss or gain on disposal of assets. Okay. So they recorded $14 million of gains on selling their long-term assets. They're shaving off their asset. Like that's not a sign of a growing business. Their total interest expense is more than doubled. Instead of paying $28 million in the course of 3 months, they spent $54 million in interest in 3 months. So not only are they losing money from their operations, but they're also paying interest expense of $54 million. So that's an extra. Now we're at a $200 million loss. Normally, you want your operating income to be higher than your interest expense. That means you can you can service your debt. They're not servicing their debt, okay? They're servicing truckers. Capitalized interest. I don't know, maybe they're like, I don't know, I don't know what they're doing with capitalizing interest. Basically, that's like, I don't know, what are they doing there? I guess it's like they're capitalizing interest means you're putting it as an asset on the balance. Instead of expensing it in the current period, you're adding the interest to an asset for something because you're paying interest for something that you're constructing or whatever. So for some reason, they're capitalizing a little bit of interest. I don't know why. We'll see. Interest income is okay. So they made $12 million of interest income versus 15. So their interest income is going down. And I bet you this because they're probably burning cash and having to sell marketable securities to use in cash burn. They're losing money hand over fist. Okay. They swung to massive loss. Okay. You can see, so top line revenue dropped. Top line revenue dropped 10%, and bottom line profit dropped an insanely high percentage, 9,600% or whatever, 96,000%. So just a small decline in revenue means massive losses. That doesn't sound too appealing to me. All right, let's look at the balance sheet. So they do have $724 million of cash and $115 million of short-term investments and $216 million of accounts receivable. Now, this restricted cash, I mean, I'm not going to include that, like looking at cash burn, but because that's cash that's set aside for whatever reason. I don't know if it's customer deposits or what. But the restricted cash is cash that's like set aside for a special purpose. But they mostly do have like liquid capital on hand. I mean, they have, let's see, if we take out the prepaid. So prepaids are things you've paid in advance. So they're not super liquid, basically. So if we take out 1,425 minus 247 minus 120. So if you exclude prepaids and restricted cash, they have about $1 billion of like roughly very liquid capital, either cash, short-term investments that they could sell and convert to cash, or accounts receivable, which is money they're going to collect in the short term. Their current debts are not looking too pretty, okay? So within a year, okay, they got accounts payable, air traffic, they owe $1.5 billion that they have to pay within a year. So they're burning cash. They have to pay $1.5 billion within the next year of short-term debts, accounts payable, employee salaries, air traffic control or air traffic liability, current maturity of long-term debt. They owe $1.5 billion within the next year, and they have roughly $1 billion of very liquid capital to pay that off. Okay. That's not too good. Long-term debt. Okay, let's compare long-term debt to long-term assets. So let's see. Property, plant, and equipment. So they have flight equipment, like airplanes. And we can see the actual, like, gross balance went down. So the reason is they're selling off their aircraft or some of them. Ground equipment, and they have accumulated depreciation of $1.2 billion. So roughly, they've used up roughly 36% of their long-term assets. Like they said, we think these assets are going to last 10 years. and the average age of the assets, hypothetically, if it was a 10-year asset, is 3.6 years. Basically, their equipment's not super old. They don't have super aged equipment that has to be replaced soon, and they're selling it off anyway. But you can see that their leases have increased. So they're, instead of buying and freaking paying for aircraft, they're increasing the amount that they're leasing. They're trying to cut costs there, it looks like. Pre-delivery deposits on flight equipment. So it looks like they made, some deposits. They're paying in advance for equipment they're buying. But look at that. Look at the drop in pre-delivery deposits on flight. So they're cutting down. They're basically saying, we don't need all the crap. Okay, we don't. Hopefully they didn't forfeit those deposits. But you can see that their deposits are going down because they don't want to be owning all this equipment when they can rent it to probably save costs. Deferred heavy maintenance. I've never seen that on a balance sheet, but apparently there's a deferred heavy maintenance asset account. Is there a corresponding liability? That's interesting. I don't even know what that is. Deferred heavy maintenance, an asset. Okay, I don't understand that. But it's probably its future expense, probably. They're probably just saying, oh, this is how much maintenance we think we're going to have to pay over the long run. Okay. Let's see. So that's their long-term assets. They're selling off some planes and they're trying to rent more. That's basically what they're doing. And they're cutting back prepayments on future equipment. Let's see. Long-term debt. So they got their long-term debt has increased by about $75 million. Their operating lease liabilities have gone up because they're leasing a lot more now. Deferred income taxes, I wouldn't even worry about that. And then deferred gains and other long-term liabilities. So overall, their debt picture isn't the net. Their long-term debt doesn't look horribly abysmal. Okay, at least they have some theoretical equity in their flight equipment and ground equipment. So that's fine, I guess, But the real problem is their liquidity. Their liquidity is getting crunched. I mean, you can clearly see that in the course of 6 months, they burned approximately, let's see the exact number. They burned approximately $87 million of current assets in 6 months. So I guess not the worst cash burn, but we'll see what's going on the statement of cash flows. Okay. Woo! So, in 6 months, they burned $269 million of cash from operations. $269 million. And on top of that, they also, they're selling property, plant, and equipment. So it's kind of hard to predict what their cash burn is going to be, because what they're doing is they're losing money from their core operate. They're burning cash. They burned $269 million in the last 6 months, but they're compensating for that by selling long-term assets and pre-delivery. Okay, so they got the refunds for the flight equipment, and this won't last forever. But basically, they're selling their equipment to stay alive. That's what they're doing. I mean, just to make it as clear. So they have a lot of equipment they can continue to sell. I mean, that's going to cut into their future revenue, obviously, unless the planes they're renting can compensate for that. But okay, technically, if they burn $269 million in, and they have $1.4 billion of assets, I mean, they could last a couple years. And I think they're going to survive in the short term, is what I'm saying. As long as they can freaking keep selling their equipment off, they can last a long time. But that doesn't mean it's a good investment. It's still, they have a long way to go before they even make freaking money. It's not good that you're selling long-term assets. So that's basically what they're selling their planes to stay alive. And they issued long-term debt. So the question is, why do they issue long-term debt? Well, basically, they're issuing long-term debt to, I don't know, freaking pay operating expenses. Usually you want to issue long-term debt if you're doing an acquisition or you're buying long-term assets. They're issuing long-term debt to stay afloat, basically. So overall, I mean, they could probably last, at least a year. They'll probably cut it close. They can last at least a year, looks like. And if they keep selling equipment, I mean, they got a lot of equipment to sell, but that's going to hurt their future prospects. So it's not good. I mean, it looks like competition is just absolutely crushing these dudes. Let's see what they have to say. The company is currently in discussions with representatives to negotiate the terms for refinancing or extending its existing 8% senior secured notes due September 2025. Uh-oh, how much is coming due? That's concerning because if you look at it, so when you look at the balance sheet, it shows current maturities of long-term debt. So whatever that amount that was coming due in September wouldn't show up here. It would show up down here. But when September rolls around, that current amount due is going to go up to current liability. So this may look even worse. And if they have long-term debt due in 2025, they either go bankrupt or they refinance it. Or they get new debt at probably crazy interest rates. There's no guarantee the company will be able to extend or refinance its existing 8% notes or its convertible notes due 2026. Let's see. The company has assessed the impact of the current pricing environment and its planned policy changes on its liquidity requirements over the next 12 months and concluded that it's probable the company will have sufficient liquidity to meet its future cash needs. So they're saying, we think we can do it. We think we can make it in the next 12 months from June. What I would do, so they're going to release their annual audited report because these quarterly ones usually aren't audited. So they're going to release their audited annual report on, sometime probably like February or March, something like that. You need to read what the auditors are saying because the auditors will usually make an opinion. They'll say, we think there may be a going concern. There's substantial doubt about this company's ability to continue as a going concern. That means the auditor thinks they're probably going bankrupt. So that's what you need to really look at. But the company's saying, we think we can make it over the next 12 months. As long as we can, refinance this debt that's coming due September 2025. Let's see how much debt's. Okay, so we know, I think JetBlue tried to acquire them and they got shut off. Let's see. Oh, what's this? On July 23rd, RTX Corporation, parent company of Pratt & Whitney, announced that it determined that a rare condition in the powdered metal used to manufacture certain aircraft engine parts will require accelerated inspection. The temporary removal of engines from service has driven and is expected to continue a significant decrease in the company's near-term growth projections. The company has reduced capacity and amount and timing commensurate with the currently scheduled removal and inspection. Oh, so they're selling assets. Their engines are potentially hazards. They're cutting flights. Not looking good. But they said, we think we're going to survive. Okay, so I think they talk more about, we think this is the future expenses that we're going to have to pay. Let's see. Yeah, I mean, revenue's collapsing both domestically and in Latin America. Fair revenue is taking a big hit. Non-fair actually didn't drop that much. I think non-fair is like all the little gimmicks that they charge. Okay. So they talk about all the assets they disposed. They 4 aircraft sale leaseback transactions. Okay. So a leaseback is when you own something, you sell it, but instead of giving it up, you instantly start renting it. So what that does is you get to keep using something that you had owned before, and you generate a bunch of cash, but you no longer own it, and now you're paying rent on it. That's what a leaseback is. So basically, they sold 4 aircraft, but they kept using them, and now they're renting them. That's a leaseback. And they recorded some gains or losses, but, I mean, oh, wow. They made some accounting profits on aircraft that they sold that they now are renting. Okay. During the 3 months ended June 30th, the company completed the sale of 5 A319 airframes and 9 A3 engines and recorded a gain of $600,000. During the 6 months ended June 30th, the company completed the sale of 10 A319 airframes and 24 A319 engines and recorded a loss. They lost money on a sale. Okay, so basically they're doing lease. They're selling some stuff and they're lease backing others. Okay. Special charges. What are they? They blow $27 million on the merger that didn't go through. Okay. Good job there, Spirit. Okay. Their short-term investments are mostly in treasuries and government agencies. Okay, nothing crazy there. Leases. Let's see. Okay, we know they're leasing more now. They're doing lease backs. Okay, here's the... Oh, this is the operating leases. I'm trying to see the long-term debt. Some litigation, credit card processing. Okay, long-term debt. Let's see. When's it due? Okay. So they have 8% senior secured notes, fair value level hierarchy, level 3. I mean, this is money that they owe. So the estimated fair value of the secured notes have been determined to be level 3. The company utilized this for the fair value, blah, 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 blah. Are these the 8% notes that are coming due? Because that's what they were talking about, right? I'm seeing $1.1 billion coming due in September. That's a little scary. If I'm looking at this correct, because they mentioned the 8% notes, right, that are coming due in September. $1.1 billion coming due in, well, from now, a year and a couple months. Okay. That doesn't look too good. Here we go. Convertible note. Okay, these are the convertible notes. I thought they were... Yeah, I think these are different from the other ones that they were talking about. This is dangerous, okay? Like, you basically... Let's see. Okay, yeah, here it is. At June... Okay, this is bad. Long-term debt principal payments for the next 5 years, and so all the huge chunk of their long-term debt is coming due in 2025. That's scary. $1.2 billion is coming due in the course of a year and a couple months. $1.2 billion. There's a chance this thing may go under within a year and some change. They got to figure out this freaking debt that's coming due. That is a lot of debt that's due in 2025. Now, if this was out like to 2029, okay, maybe we don't have to worry about that. But they got $1.2 billion coming due within 2025. And interest rates are high, and this company's a freaking penny stock. They're going to have very bad financing terms. Or if there are convertible bonds, if they get like refinanced to convertible bonds, you as a shareholder, you're going to be annihilated with dilution. That's not good. Okay, this is a huge red flag right here. $1.2 billion coming due in 2025. So obviously, you do whatever you want with your money, but let's just say I would not put my entire portfolio in this. Okay, I'd be interested to see the report, the report at the end of the year. But this is not good. Okay, this thing could go under within a year and some change whenever that long-term debt comes due. Because like, what are their options? Dilution, like they're a freaking penny stock, or refinancing at a massively high interest rate. Would you lend this company money? Really? Would you lend this company money? I'm just saying. Good Lord. So that was a sponsored video, ladies and gentlemen. If you want a sponsored video, see the pinned comment below the conclusion of this live stream. It's $50 and I'll make a video about whatever you want, except stock price predictions. Check out my book, Stop Being a Broke Loser. It's on Amazon. And if you want one-on-one accounting tutoring, see the pinned comment below. I'm a CPA, $75 an hour. Damn, how the heck do these companies lose so much money? Well, I mean, they're just happens, bruh. That long-term debt, that's not good. Crash landing, yeah, this company's terrifying. Is Spirit the future? Yes, all in your portfolio, your kid's portfolio, your mom's portfolio. If you manage a pension fund, all in, everything. Never invest in airlines. Extremely recession regulations. Yeah, I mean, they got busted by the freaking feds trying to form a monopoly. Strongman's too lazy to make another video. Man, I'm tired. It's 10 o'clock. It's very risky. This is like something you like, oh, maybe the shorts are going to cover. And then I made a quick buck. But long term, this is terrifying. I have 23 shares. Why? I wish you the best, good sir. Thanks, Elizabeth Warren, Trust Busters. Good job. You saved America. We have these massive monopolies, large cap tech. I mean, they're starting to get attention now from what I hear. But then Spirit tries to get acquired. Oh, no. It doesn't make any sense. Is Spirit in VT? If it is, it's like 0.0001% of VT. Shawman, I'll give you 50 V-Bucks. Hey, as long as you know, I'm not doing stock price predictions. I am not doing valuations. I am looking at financial statements, okay? And you should put 95% plus of your portfolio in total market index funds and tax advantage accounts. That is my not financial advice. All in on Palantir. Good for you, buddy. This looks like a Lafufu stock. No, Lafufu, like, I don't think he's dumb enough. Well, actually, you know what? He is dumb enough. The margins are too good for him to buy this stock. They're in line to receive new planes from Airbus. Yeah, but they've been processing refunds. Like, they're getting hammered left and right. Just buy see, tomorrow the stock will go up. People, you're stupid because the stock went up. I'll be like, 1.2 billion of debt is coming due within a year and some change. And did you look at the fight? They're losing money every single quarter. They have negative operating cash flow. They're selling off assets to stay alive. It's not good. Imagine that you're the airline everybody hates and you suffer. And I freaking hate budget airlines. You want to know why? Because when I flew to Florida, when I came back, they just canceled my flight. Breeze Airlines, they just canceled my flight. I checked my email in the morning. I thought I was going home. And the email says, the crew has fallen ill. We have not been able to find new flight attendants. Therefore, the flight is canceled. That's literally the email I got. I'm like, what the heck? And then you try to call, there's no customer service. Like, they're like, oh, we'll reimburse you $150 for hotels. And it's like this sketchy thing. They're like, oh, you have to apply for your reimbursement within 7 days to get the $150 or it goes away. I'm like, what? It's just Jesus. 78%. Yeah, this thing's in trouble. All them illegals gonna have to take cheap flights back home for the holidays. That's right. What's their whack? I don't even want to know. You think I want to calculate their weighted average cost of capital? Wonder what kind of deferred maintenance there is on the balance sheet. That probably had something to do with the engines they had trouble with there. Will you take 50 Club Penguin? No, I want real money. I don't want fake clown money. I don't take crypto. Need to save a shout out. Short squeeze. Roaring kitty. Do they serve tattooed chef on flights? No, I actually have the last tattooed chef meals in my refrigerator. I'm going to sell those in 10 years for like $10,000 a piece. I'm going to make that. When I become famous, I'm going to sell those off. Woo! Hello, strong man. All right, that's Spirit Airlines. I mean, they're burning cash. I would pay attention to the annual report that comes out at the end of the year and see what the auditors have to say. I personally would be a little terrified that $1.2 billion, which is, by the time they get to next year, they're going to have less than $1.2 billion in current assets unless they sell more of their planes because they're burning cash in their operations. And if we enter a recession, oh boy, they're done. So, whatever. Clown stock. Anyway, hope you enjoy the video. Give me your money. I'll make personalized videos. I'm wrapping up some tax returns. Then I'll be done. Then I can focus on YouTube again. And you guys have a wonderful, delicious day. Cheers.